A credit score looks harmless. 3 digits, a small box on a screen, a number people check, worry about, and move on from. But in practice, that score can decide what borrowing will cost you. That is where the real power begins. A credit score is often treated like advice, a rough summary, just another signal in the background. But the official language is colder than that. The Consumer Financial Protection Bureau defines a credit score as a prediction of your credit behavior based on information in your credit reports. Its FCRA Procedures Manual goes further. A credit score is a numerical value derived from a statistical tool or modeling system used by a lender or loan arranger to predict certain credit behaviors, including default. That means the score does not just sit there. It enters a workflow. And once it enters a workflow, it starts acting less like information and more like permission. The score is not magic. It does not know your future. It is just a system's way of sorting risk fast. What it does is give institutions a quick way to compress a messy credit history into a single risk signal. Payment history, balances, delinquencies, collections, utilization, and the age of accounts all get boiled down into something a lender can sort quickly. And once enough institutions trust that shortcut, the shortcut becomes real. You can see that most clearly in mortgages. Fannie Mae's guide is blunt. The representative credit score for the loan is used for pricing on all loans and for eligibility on certain manually underwritten loans. That is not decorative language. That is the score entering the machinery that decides what the loan costs. The guide then shows how that score is chosen. When 2 credit scores are obtained for one borrower, the lower score is used. When 3 scores are obtained, the middle score is used. And when there are multiple borrowers, the lowest applicable score in the group can become the representative credit score for the loan. So the score is not just floating in the background. In real mortgage handling, it gets standardized, selected, and applied. The file is not being read from scratch in any full human way. It is being translated into something the system already knows how to trust. And in some cases, the floor is explicit. Fannie Mae's guide says the minimum credit score for loan eligibility is 620 on fixed-rate loans. For adjustable rate mortgages, it is 640. Government mortgage loans also require a minimum representative credit score of 620. Certain manually underwritten loans operate with minimum score logic as well, with listed exceptions. So before the rest of the file is even argued over, the score can already be acting like a gate. And the pressure does not begin only when the system says no. Sometimes the real penalty is that the system still lets you in, just on worse terms. CFPB's risk-based pricing rule shows exactly how that works. One example uses a 720 cutoff. A consumer with a 700 score falls below it and receives a risk-based pricing notice. Another uses a 750 cutoff. A consumer with a 740 score falls below that one, and again receives a risk-based pricing notice. The rule also describes tiered pricing structures where borrowers outside the best price tier receive materially less favorable terms. That matters because denial is obvious. A worse lane is quieter. You still get the offer. You still move forward. You still sign something. But the terms are worse. The payment is heavier, and the room for error is thinner. The score does not always throw you out. Sometimes it simply makes ordinary life more expensive. CFPB's mortgage guidance makes that pressure easy to picture. Borrowers in the mid to high 700 generally receive the lowest rates and the most options. From 680 to 740 rates usually rise. From 620 to 680, borrowers often face the highest rates and the fewest choices. Below 620, many borrowers struggle to qualify at all. That is not a theory about how the market feels. It is a practical ladder. And on that ladder, a small change in score can change where a borrower lands. Oh, not always from approved to denied. Sometimes the damage is quieter than that. The loan still exists. The terms just stop making sense. And that can be enough to knock a borrower out without ever producing a clean rejection. Sometimes the shift is from manageable to tight, from several workable options to very few, from a payment that fits to one that quietly changes the rest of the month. That is what the score is doing in real life. A person starts with what feels like a normal question. Can I afford this house? Then the file goes through underwriting, the representative score is selected, the pricing logic activates, and the real question becomes narrower. What are you allowed to afford now? That question does not just change the payment. It changes the shape of the decision itself. One score can turn a broad search into a narrow one, a safe budget into a strained one, and a workable plan into something that only works if nothing else goes wrong. A higher monthly payment can knock out one neighborhood, then one lender, then one backup plan. It can turn a borrower who looks safe on paper into someone shopping under tighter deadlines, thinner savings, and fewer acceptable terms. The file may still be alive, but the range of workable decisions is already smaller, and that is what makes the score feel so invasive. It is not only measuring the past. Inside the workflow, it is reshaping the next move. It looks personal, but its power is institutional. Lenders use it. Mortgage systems price with it. Enterprise rules define how it is selected and applied. Federal consumer rules already assume it can push borrowers into materially more expensive terms. And once that score pushes a file into a worse lane, the damage does not stop at the quote. It can shrink the lender pool, weaken the fallback plan, and make one ordinary decision more expensive for years. And the current mortgage transition makes the same logic even easier to see. FHFA says, Classic FICO remains an approved model for loans sold to the enterprises. FICO 10T is approved for future use. Until then, lenders may choose between Classic FICO and Vantage Score 4.0. That means the model can change while the gate stays the same. Fannie Mae notes that after FHFA's July 2025 announcement, lenders could begin using either Classic FICO or Vantage Score 4.0 under the Tri-Merge credit report requirement. That matters because it shows the power was never in one sacred model. It was in the system that agreed to trust one. And once a system can do that in lending, it becomes easy to repeat the shortcut somewhere else. The spillover goes beyond mortgages. CFPB reports that tenant screening systems frequently include credit history and credit scores in the reports landlords use to evaluate applicants. Insurance companies may use credit-based insurance scores to price policies. The same logic keeps repeating. A report becomes a shortcut. A shortcut becomes a filter. A filter becomes a pricing tool. And a pricing tool quietly determines what stays within reach. That is why the score feels larger than it looks. Not because 3 digits are secretly wise, but because institutions decided those 3 digits were legitimate enough to act on. Once the score is trusted enough to set the lane begins shaping the life around it. So who gave your credit score this much power? Lenders did. Mortgage infrastructure did. Pricing systems did. Every institution that decided a compressed risk signal was good enough to stand in for a deeper human reading of the file did. The score is not powerful because 3 digits are wise. It is powerful because entire institutions agreed those 3 digits were enough to decide who pays more, who gets fewer options, and who gets through at all.